Hi everyone, I recently just finished reading the book Psychology of Money. It is such a good read and I strongly recommend everyone finish reading the whole book. But if you are time poor, here are the most important lessons I believe everyone should learn from the book. People love to use historic events to support their current view or predictions on the market. It sounds something like, I think we're going to experience XYZ because similar things happened in 2008, or I think the stock price of company X is going to triple because company X is a much younger company Y, so their share price should follow a similar trajectory. This type of argument sounds convincing, but the book tells us why we should be careful on this type of predictions. First, we have the tendency to start our reasoning from record-setting events, things like Great Depression, World War II, 9/11, the 2008 financial crisis. But these events are rare and most importantly, very surprising at the time when they occurred. I mean, this is the reason why they are so disruptive. It's like if everyone can foresee a crisis coming, then the crisis will not occur because people will do something to prevent it from happening. So if the predictions are based on events that are rare, then by definition, the odds of them being accurate is very low. Second, the most important economic events in the future, events that will move the needle the most, are things that history gives us little or no guide about. They will be unprecedented events. This means we won't be prepared for them, which is part of the reason why they are so impactful. That doesn't mean we should ignore history when we think about money, but there is an important nuance. The further back in history we look, the more general our takeaway should be. General things like people's relationship to greed and fear, how people behave under stress, and how they respond to incentives tend to be stable over time. The history of money is useful in that kind of stuff. But specific trends, trades, or specific sectors, specific causal relationship about the markets, and what people should do with their money are always examples of evolution in progress, and we should apply our critical thinking when we look at these things through the lens of history. So a big reason why a lot of people are scared of stock market investing is volatility. So they either avoid volatility by staying out of the market altogether, or they try to take advantage of the volatility by doing short-term trading. I mean, to be clear, I consider myself as a long-term investor and I don't have much experience doing short-term trading. I know people can definitely make a profit on short-term trades, but I do doubt whether they're going to have a better return over a long period of time. And a survey done by Morningstar actually supports this. So Morningstar is an investment research firm, and they once looked at the performance of technical mutual funds whose strategy is doing short-term trading between stock and bonds by timing the market. So their study focused on periods from mid-2010 through to late 2011. So this is the period where the US stock market went wild on fears of a new recession, and the S&P 500 declined more than 20% during the period. So this is exactly the type of environment where these technical mutual funds are supposed to work in. I mean, it's their time to shine. So there were about 112 technical mutual funds in their study. Interestingly, their research found that only 9 out of that 112 mutual funds have a better risk-adjusted return than a simple 60-40 stock-bond allocation. Also, less than a quarter of those technical mutual funds had a smaller maximum drawdown than the Leave It Alone index. The research reminds me of an old saying, and that is time in the market beats timing the market. As an everyday investor, how should we think about volatility so that we can keep calm and stay in the market? The book tells us a simple psychological trick. It sounds trivial, but think of market volatility as a fee rather than a fine is an important part of developing the kind of mindset that will let us stick around long enough so that the investing gains will work in our favor. For example, think of the market volatility as a ticket to Disneyland. Disneyland ticket costs $100, but you get an awesome day that you will never forget. Last year, more than 18 billion people went to Disneyland, and obviously they thought that fee was worth paying. So they think of that as a fee rather than a punishment or a fine. The worthwhile trade of a fee is obvious when it is clear what we are paying for. Same with investing. Volatility is almost always a fee, not a fine or punishment. This is because market returns are never free and will never be. They demand us to pay a price like any other products or services. We're not forced to pay the fee, just like we're not forced to go to the Disneyland. We can go to the local county fair where the ticket might be just $10, or we can stay at home for free. We might still have a very good time, but we'll get usually what we pay for. So same with markets, the volatility or uncertainty is the price of returns. And remember, if the market goes down due to volatility, we'll have a paper loss, and we'll only realize that paper loss when we decide to sell. There are millions of ways to get wealthy, and there are plenty of books teaching us how to do that. But there's only one way to stay wealthy, and that is some combination of being frugal and paranoia. And the book explains why. That is because getting money requires taking risk, being optimistic, and putting ourselves out there. But keeping money requires the opposite of taking risk. It requires humility and the fear that what we've made can be taken away from us just as fast. It requires being frugal and accepting that at least some of what we've made is due to luck. So past success cannot be relied upon to repeat indefinitely. I mean, this lesson is particularly important to me as it made me understand that getting wealthy and staying wealthy are two completely different things. Step one in the world of investing is survival and not being wiped out by the market or by my own mistake or a combination of both. It made me appreciate three important things which I think are very important in the current market environment. First, more than I want big returns, I want to be financially unbreakable. I actually think I will get bigger returns because I will be able to stick long enough for the compounding interest to work in my favor. Second, planning is important, but the most important part of every plan is to plan on things when things are going not according to the plan. Third, be optimistic about the future, but also be paranoid about what might prevent us from getting to the future. Investing is often considered as a soft skill rather than a hard science because it involves a high degree of subjectivity and requires a wide range of skills beyond just analytical or technical knowledge. While there are certainly technical aspects to investing, such as financial analysis or risk assessment, these skills alone are not enough to be a successful investor in the long run. To be a successful investor, we need to have a deep understanding about human psychology, as well as the ability to assess and manage risk, make informed decisions under uncertainty, and communicate effectively with others. Investing also requires creativity and the ability to adapt to changing market conditions and economic trends. In addition, investing is heavily influenced by external factors that are difficult to predict or control, such as political instability, natural disasters, and global economic shifts. This unpredictability makes investing less of a hard science and more of an art form that requires a combination of technical skills and human intuition. Okay, there you have it, 5 lessons I learned from the book Psychology of Money. I hope this turned out to be helpful to you. If you've already read the book, what are the most takeaways that you have? Let me know in the comment section below. Thanks for watching, and I will see you next week.